The success of Warren Buffett is often explained through numbers, investments, and billions of dollars. But numbers alone do not explain his success, because the truth is simple. Many people understand markets. Many people study finance. Many people read the same books, yet very few reach the level of Buffett. The real difference is psychological, not strategy, not intelligence, but mindset. The market is a place where emotions dominate decisions: fear, greed, impatience, panic. Most participants react to these emotions without realizing it. Prices rise and excitement spreads. People rush in because they believe they are missing an opportunity. Prices fall and fear takes control. People sell because they believe everything will collapse. This emotional cycle repeats again and again. But the mind of Warren Buffett operates differently. Instead of reacting emotionally to the market, he observes it. Instead of following the crowd, he studies their behavior. Because to Buffett, the market is not a place to follow opinions. It is a place to observe human psychology. One of the most powerful psychological principles Buffett lives by is independent thinking. Markets reward those who can think for themselves, but independence is extremely rare. Why? Because human beings naturally seek validation. We want confirmation that our decisions are correct. We want to know others agree with us. And that desire leads to one dangerous habit: following the crowd. But crowds in financial markets are rarely rational. They become emotional. They chase trends. They panic during uncertainty. And they abandon logic when fear becomes loud. Buffett understood early that following the crowd is often the fastest way to lose money. So he built a different psychological rule: think independently. Make decisions based on logic, not popularity. Because when everyone agrees on something in the market, the opportunity is usually already gone. Another psychological strength that separates Buffett from most market participants is patience. Patience sounds simple, but in financial markets, patience is extremely difficult. Most people enter the market expecting quick results, fast profits, immediate rewards, constant action. But the market does not reward impatience. In fact, impatience often destroys performance. People trade too frequently. They chase movements. They abandon long-term thinking for short-term excitement. But the mind of Warren Buffett rejects this behavior completely. Buffett once explained that the market transfers money from the impatient to the patient. That single statement reveals a powerful psychological truth. The market is not designed to reward activity. It rewards discipline. It rewards restraint. It rewards those who can wait while others rush. Another defining characteristic of Warren Buffett's mindset is emotional stability. Markets move through cycles: booms, crashes, optimism, fear. But emotional traders allow these cycles to control their decisions. When the market is rising, confidence becomes excessive. People believe prices will rise forever. When markets fall, panic takes over. People believe everything is doomed. This emotional instability creates irrational decisions. But the psychological discipline of Warren Buffett resists this cycle. He does not allow fear or excitement to dictate his actions. Instead, he remains calm while others react emotionally. And this calmness creates opportunity. Because emotional markets often create irrational prices, and irrational prices create opportunity for those who remain rational. Another powerful psychological trait in Buffett's mindset is the ability to ignore noise. Financial media constantly produces opinions, predictions, urgent headlines, breaking news. But most of this information is designed to capture attention, not improve decision-making. Noise creates distraction, and distraction weakens discipline. But the philosophy of Warren Buffett avoids this trap. He does not allow headlines to dictate decisions. He does not react to daily market commentary, because short-term noise rarely changes long-term reality. This ability to ignore noise creates mental clarity. and mental clarity leads to better decisions. Perhaps the most misunderstood part of Buffett's psychology is simplicity. Many people believe success in financial markets requires complex systems, advanced formulas, endless indicators, constant analysis. But Buffett's philosophy is the opposite. He believes complexity often hides confusion, and confusion leads to mistakes. Instead, he focuses on clarity, simple ideas, clear logic, strong discipline. This mental simplicity allows him to avoid unnecessary risks and focus only on opportunities that truly make sense. And that clarity becomes a psychological advantage, because the more complex a decision becomes, the easier it is for emotion to interfere. The mindset of Warren Buffett also demonstrates an extraordinary understanding of long-term thinking. Most market participants measure success in days or weeks. They want fast results, immediate validation, quick profits. But Buffett's perspective operates on a completely different timeline: years, decades, generations. This long-term thinking changes the entire psychological framework of decision-making. Short-term fluctuations become less important, temporary losses become less emotional, and discipline becomes easier to maintain. Because when your time horizon expands, daily noise loses its power. Another psychological rule Buffett follows is protecting capital. Many people focus only on profit, how much can be made, how quickly wealth can grow. But Buffett focuses first on what must never happen: permanent loss. Because once capital disappears, opportunity disappears with it. This mindset forces careful decision-making. Risk is evaluated before reward. Protection is prioritized before growth. And this discipline creates long-term stability. The psychology of Warren Buffett ultimately reveals something important about financial success. Markets do not primarily reward intelligence, they reward temperament. The ability to remain calm while others panic. The ability to remain patient while others rush. The ability to remain logical while others react emotionally. Temperament becomes the true edge, because emotional control allows rational decisions, and rational decisions compound over time. Most people enter financial markets searching for the perfect strategy, the perfect indicator, the perfect system. But Buffett's success demonstrates a deeper truth. Strategy matters, but psychology matters more. Because even the best strategy fails if emotions control decisions. And even a simple strategy can succeed if discipline controls behavior. The market constantly tests human psychology. Fear tests confidence. Greed tests patience. Uncertainty tests discipline. And those tests never disappear. But the mindset demonstrated by Warren Buffett shows that mastering psychology is often more important than mastering markets. Because the greatest challenge in finance is not predicting price movements, it is controlling human behavior. And once that psychological control is developed, the market begins to look very different. When psychological control begins to develop, the way a person sees the market starts to change. Price movements stop feeling like personal attacks, losses stop feeling like failures, and uncertainty stops feeling threatening. Instead, the market begins to look like what it truly is: a reflection of human behavior. Every rise in price reflects optimism. Every fall reflects fear. Every bubble reflects greed. Every crash reflects panic. Understanding this pattern of emotions allows a disciplined mind to operate differently from the crowd. And this is exactly the environment where the psychology of Warren Buffett becomes powerful. Because Buffett does not see the market the way most participants do. He does not see a battlefield of predictions. He sees a mirror of human emotion. And that perspective creates opportunities that emotional traders often miss. One of the most famous principles associated with Buffett's mindset is simple but extremely difficult to practice. Be fearful when others are greedy. Be greedy when others are fearful. This idea is not just a clever quote, it represents a deep understanding of market psychology. When prices are rising rapidly and everyone feels confident, something dangerous is happening. People stop thinking rationally. They begin to assume the trend will continue forever. Risk feels invisible. But at the same time, prices often move far beyond their true value, and that creates danger. Buffett understands that excitement in the market often signals the moment when caution is necessary. On the other hand, when markets fall sharply and fear spreads everywhere, another psychological mistake appears. People assume the future will only get worse. They sell because they want relief from uncertainty. They abandon logic because fear becomes overwhelming. But fear often creates the very opportunities disciplined investors wait for, because panic can push prices far below their true value, and the calm mind recognizes that difference. Another important mental principle behind Buffett's success is the ability to remain inactive. Inactivity sounds strange in a financial world that constantly celebrates action. Most people believe success comes from doing more trades, more decisions, more reactions. But markets often reward those who can do nothing. And doing nothing requires psychological strength. Because inactivity feels uncomfortable, silence feels uncomfortable, waiting feels uncomfortable. The human mind constantly wants stimulation, it wants movement, it wants activity. But the mindset of Warren Buffett embraces patience as a strategic advantage. He has often explained that the market does not require constant action. Opportunities appear at irregular intervals. Sometimes nothing worth doing appears for long periods, and the disciplined mind simply waits. This ability to remain inactive protects capital and prevents emotional mistakes, because many financial losses occur not from bad opportunities, but from unnecessary activity. Another psychological trait that stands out in Buffett's thinking is humility. Humility in financial markets is not weakness, it is protection, because arrogance blinds judgment. When people become too confident, they stop questioning their assumptions, they stop considering risks, they begin to believe they cannot be wrong, and the market eventually punishes that belief. But humility creates a different mindset. It allows constant learning. It allows mistakes to become lessons. It keeps the mind open to new information, and this openness protects against dangerous overconfidence. The mindset of Warren Buffett reflects this humility. Despite extraordinary success, he continues to emphasize learning, discipline, and careful thinking, because financial markets constantly evolve, and humility keeps the mind adaptable. Another important psychological principle in Buffett's approach is clarity of focus. The modern financial world is filled with distractions, thousands of stocks, constant news, endless opinions, predictions from analysts, social media discussions. All of these things compete for attention, but attention is limited, and distraction weakens decision-making. Buffett avoids this trap by focusing only on opportunities he truly understands. He often describes this as operating within a circle of competence. Instead of trying to understand everything, he focuses on what he understands deeply. This psychological discipline removes confusion, it eliminates unnecessary risk, and it allows decisions to be made with greater confidence. The psychology behind Buffett's success also reveals something important about consistency. Consistency does not come from perfect predictions. It comes from stable behavior, stable habits, stable thinking. Many people believe financial success comes from one brilliant decision, but long-term success is usually the result of many disciplined decisions repeated over time. Small advantages, repeated again and again. Patience, risk control, clear thinking. These qualities compound slowly, just like capital, and over time, the results become extraordinary. When people look at the wealth accumulated by Warren Buffett, they often focus on the size of the outcome.
But the real story is the psychological discipline that made that outcome possible. Because wealth in financial markets is rarely created by luck alone. It is created by behavior, by mindset, by the ability to remain rational in an environment dominated by emotion. And that is the deeper lesson behind Buffett's success. The market constantly tests human psychology. It tests patience, it tests discipline, it tests emotional control. And the individuals who succeed are not necessarily those who know the most. They are the ones who control themselves the best. Because in the end, the greatest challenge in financial markets is not understanding price movements, it is mastering the mind that reacts to them.
There is another psychological layer behind the success of Warren Buffett that many people overlook: the ability to remain emotionally detached from short-term outcomes. Financial markets move every second. Prices rise, prices fall. News appears, predictions change, and many participants feel the need to react constantly. They watch every movement, they monitor every fluctuation, and without realizing it, their emotions begin to move with the market. When the market rises, confidence rises. When the market falls, anxiety appears. This constant emotional attachment creates instability in decision-making. But the psychology behind Buffett's success rejects this pattern completely. He does not treat daily price movements as signals that demand emotional reactions. Instead, he treats them as information, nothing more. Because price movement alone does not always represent value. Sometimes prices move because of excitement. Sometimes they move because of fear. Sometimes they move simply because the crowd is reacting to temporary events. And reacting emotionally to every movement creates a dangerous habit. It encourages impulsive decisions. The disciplined mindset avoids that trap by separating emotion from evaluation. Evaluation requires logic. Emotion creates distortion. And the clearer the mind becomes, the stronger the decisions become. Another powerful psychological principle in Buffett's mindset is the ability to delay gratification. This is one of the most difficult skills for human beings to develop. The mind naturally prefers immediate rewards, quick results, instant progress. But the world of investing and markets often rewards the opposite behavior: patience, waiting, allowing time to work. The philosophy of Warren Buffett embraces this principle completely. He understands that wealth does not grow through constant activity, it grows through compounding. Compounding requires time, and time requires patience. This long-term perspective changes how decisions are made. Instead of chasing quick gains, the focus shifts to sustainable growth. Instead of reacting to short-term fluctuations, the focus remains on long-term outcomes. And that psychological patience becomes a powerful advantage, because while others chase immediate gratification, the patient mind allows time to multiply results. Another element of Buffett's psychology is emotional independence. Many decisions in financial markets are influenced by social pressure. People observe what others are doing, they watch trends, they follow popular opinions, and slowly those external influences begin to shape their decisions. But social influence is often strongest at the worst possible moments. When prices rise quickly, excitement spreads. Everyone begins to believe the opportunity cannot be missed. And when prices fall rapidly, panic spreads just as quickly. Everyone begins to believe disaster is unavoidable. This emotional contagion spreads through markets constantly. But the mindset of Warren Buffett remains independent from that influence. He does not rely on the crowd to confirm his decisions. He relies on reasoning, logic, evidence. This emotional independence protects decision-making from mass psychology. And in financial markets, independence is rare, but it is often where the greatest opportunities exist. Another defining psychological trait behind Buffett's success is discipline. Discipline is not dramatic. It does not appear in headlines. It does not attract attention.
but it quietly shapes every decision. Discipline means following principles even when emotions suggest doing something else. It means remaining patient when the environment encourages impatience. It means maintaining rational thinking when the crowd becomes irrational. Discipline also means accepting limitations. Understanding that not every opportunity should be pursued. Understanding that not every idea deserves investment. And understanding that protecting capital is often more important than chasing profit. This disciplined restraint is part of the psychological framework that defines the behavior of Warren Buffett. Because long-term success in financial markets often comes from avoiding mistakes rather than chasing opportunities. Another psychological concept behind Buffett's thinking is the ability to remain comfortable with uncertainty. Uncertainty is unavoidable in markets. No one can predict the future with perfect accuracy. Events happen. Economic conditions change. Unexpected developments occur. Many participants struggle with this uncertainty. They search constantly for predictions that feel certain. They want reassurance that their decisions will succeed. But certainty in financial markets is an illusion. The disciplined mind accepts this reality. The mindset of Warren Buffett does not demand perfect prediction. Instead, it focuses on probability and rational judgment. Decisions are made based on logic and preparation, while accepting that outcomes cannot be guaranteed. This acceptance removes emotional pressure. It allows decisions to remain calm and rational. And that calmness protects discipline during uncertainty. There is also another powerful mental habit that defines the psychology of Buffett: continuous learning. Financial markets change, industries evolve, opportunities shift over time, and remaining intellectually curious allows the mind to adapt. But learning requires humility. It requires the willingness to admit mistakes. It requires the willingness to question assumptions, and it requires patience to develop deeper understanding. The mindset of Warren Buffett reflects this constant learning process. He spends significant time reading, studying, and analyzing information, not because activity itself creates success, but because understanding improves judgment, and improved judgment leads to better decisions. All of these psychological traits combine to form a powerful mental framework: patience, emotional control, independent thinking, discipline, long-term perspective, humility, continuous learning. Together, they form the foundation of Buffett's success. And this foundation reveals an important truth about financial markets. The greatest advantage rarely comes from secret strategies. It comes from mindset. Because markets constantly test human psychology. They reward calm thinking. They punish emotional reactions. They reward patience. They punish impulsiveness. And over time, the individuals who develop psychological discipline begin to separate themselves from the crowd. Not because they predict every movement, but because they control their behavior while others react emotionally. And this is the deeper lesson behind the mindset of Warren Buffett. The market does not reward those who chase excitement. It rewards those who master patience. It does not reward those who react to every movement. It rewards those who remain rational when others become emotional. Because in the end, financial success is not only about understanding markets, it is about understanding the mind that operates within them. There is a moment in the career of Warren Buffett that reveals something extraordinary about psychology and wealth. A moment when his net worth increased by about $1 billion in a single day. For most people, that number sounds unreal. $1 billion in one day? It sounds like luck. It sounds like a sudden event. It sounds like something explosive. But the truth is far more interesting. Because that day did not come from a single trade. It did not come from chasing a fast opportunity. It did not come from emotional risk-taking. It came from decades of disciplined thinking. When the market significantly revalued the companies Buffett had invested in through Berkshire Hathaway, the value of his holdings rose dramatically. On paper, the increase was massive, and in a single trading session, his personal wealth increased by roughly $1 billion. But here is the psychological lesson most people miss. That billion-dollar day was not created that day. It was created years earlier. Years of patience, years of conviction, years of holding positions while others doubted them, years of ignoring noise, years of thinking independently. The market simply recognized the value later. This reveals something profound about long-term investing psychology. The results often appear suddenly, but the discipline that creates those results is slow and quiet. While many traders are chasing daily profits, the mindset of Warren Buffett focuses on building positions that can grow for years. And when those positions mature, the outcomes can be enormous. But emotionally, nothing changes for him. That billion-dollar day did not cause celebration. It did not cause excitement, because psychologically, Buffett understands something very important. Market value fluctuates every day. One day, the market may add billions. Another day, it may remove billions. Reacting emotionally to those fluctuations would destroy rational thinking. So instead, he treats them as temporary reflections of market perception, not permanent realities. Imagine the psychological control required for that mindset. Most people react strongly to small financial changes. A small loss creates stress. A small gain creates excitement. Now, imagine seeing your net worth increase by $1 billion in a single day and remaining calm. That level of emotional stability is rare, but it is exactly what separates disciplined investors from emotional participants. Because if someone becomes overly excited during gains, they will eventually become overly fearful during losses. Emotional extremes always come in pairs, but the psychology of Warren Buffett avoids those extremes completely. There is another important lesson hidden inside that billion-dollar moment. It demonstrates the power of compounding. Most people think wealth grows in a straight line, small gain after small gain, step by step. But compounding does not work like that. Compounding works quietly for a long time. Then, suddenly, the numbers become enormous. At the early stages, growth feels slow, almost invisible. But as capital increases, the same percentage growth begins to produce much larger dollar results, and eventually, one day of market movement can produce billions. That is the mathematical power of long-term discipline, and it is also the psychological challenge. Because most people quit long before compounding becomes powerful. They become impatient, they search for faster results, they abandon discipline. But the mindset of Warren Buffett allows compounding to work uninterrupted for decades. Another fascinating psychological detail about that billion-dollar day is this: Buffett did not change his strategy afterward. He did not suddenly increase risk. He did not start making aggressive decisions. He simply continued doing what he had always done: calm analysis, patient investing, rational thinking. Because the goal was never to chase dramatic moments. The goal was consistent discipline. And when discipline compounds over decades, those dramatic moments appear naturally. This is one of the biggest psychological differences between professionals and amateurs. Amateurs chase big moments. Professionals build systems that eventually produce big moments. Amateurs search for excitement. Professionals build patience. Amateurs want the billion-dollar day immediately. Professionals understand that the billion-dollar day is often the result of many quiet years of discipline. And that is the deeper psychological lesson behind that moment in the life of Warren Buffett. Massive financial results rarely come from dramatic decisions. They come from consistent behavior repeated over long periods of time, from emotional control, from patience, from rational thinking when others become emotional. Because in financial markets, the greatest fortunes are often built quietly until one day the numbers finally reveal what discipline has been building all along. There's one final psychological lesson that can be taken from the journey of Warren Buffett, and it is perhaps the most important one. Because when people study Buffett, they often focus on the money, the billions, the investments, the companies owned through Berkshire Hathaway. But the real story has never been the money. The real story has always been the mindset. Think about what it actually takes to build wealth over decades. It requires patience when everyone else is rushing. It requires calm thinking when everyone else is reacting emotionally. It requires discipline when the environment encourages impulsive decisions. And most importantly, it requires the ability to think independently. Because the crowd is almost always emotional. When prices rise quickly, the crowd becomes greedy. When prices fall sharply, the crowd becomes fearful. But the psychology of Warren Buffett is built on a completely different foundation. He does not react to the crowd. He observes it, he studies it, and sometimes he benefits from the mistakes it creates. Throughout decades of investing, the market has gone through bubbles, crashes, recessions, and recoveries. Entire industries have risen and disappeared. Economic environments have changed. Technologies have transformed the world. But one thing has remained constant: human psychology. Fear, greed, impatience, excitement. These emotions continue to influence markets just as they always have. And the individuals who learn to control their own emotions gain an enormous advantage, because they are no longer reacting blindly, they are thinking clearly. This is why Buffett's success is not just about intelligence. Many people are intelligent, many people understand finance, many people study markets, but far fewer people develop emotional discipline. And without emotional discipline, knowledge alone becomes powerless. The market will always test patience. It will always test confidence. It will always create moments of doubt. But the individuals who remain stable through those moments begin to separate themselves from the crowd. So, the final lesson from the psychology of Warren Buffett is simple but powerful. Financial success is not built by chasing opportunities. It is built by developing the mindset capable of recognizing them and holding them long enough to matter. Because wealth does not come from constant action. It comes from disciplined thinking repeated over time. It comes from patience, from emotional control, from independent judgment, and from the ability to remain rational while others become emotional. So, the next time you think about success in markets, do not ask only what strategy to use. Ask something deeper. What kind of mindset must exist to sustain success for decades? Because strategies change, markets change, opportunities change, but the psychology that creates discipline, that is what truly lasts. And that is the real lesson.